Hey everybody, Stewart Heath here, CEO and founder of Harvard Grace Capital, back with another Nerdy Numbers of the week. This is number 20 in our Nerdy Numbers series, and it's just our way of bringing some commentary on the current economic statistics that are that come out in the market, nearly every day. So this week we're talking about housing starts. So last week we got the housing starts for the month of June. It's 1,320,000 or 1.32 million, and the entire press coverage seemed to be all about, oh, but it's down from a year ago. Well, it was up from May, and everything is regional anyway. And I just find it to be curious how certain people put spins on certain data. We hit this massive high of 1.82 million housing starts way back in April of 2022, and that's right about when they started raising interest rates at a really incredible rate, and which has now slowed the housing market. It hasn't killed the housing market. We still started 1.32 million houses in this country last month. That's a lot of houses. It's 6,000 less houses than they started in June of 2024. So we missed it by less than half of a percentage point. We'll see. Single data points do not make a trend. We were up from the month prior. It did slow down. And I would like to just say, not being a builder, but once upon a time having been a builder, this has been an incredibly wet year so far, especially in the South, and it's hard to start a house when you can't move the dirt. So anyway, I think this is a pretty strong number. But there is some data to look at when it talks about, as we look at what's impacting housing. We've had a complete reversal. Going into to COVID, it was cheaper to own a house than it was to rent. And that's completely upside down now, and that's impacting housing a great deal. And the major problems with that are, number one, interest rates, no doubt. The rest of it is higher labor costs coming out of COVID. We had labor market disruption, and now higher material costs. And that's purely a supply and demand thing. It got impacted by the shipping disruptions that we had, and now it's just high. Now it's just high because there continues to be high demand, and high demand will always lead to high prices. So these are the factors. Supply and demand will ultimately deal with labor and materials. The interest rate factor, in my mind, long-term interest rates can truly only really be impacted by the government, Congress, and the president. We've seen a very good case study in the last 12 months where the Fed has lowered interest rates 3 times, yet the 10-year Treasury yield, which is what most lending is based on, is still higher than it was a year ago. In some cases, the same. It moves quite a bit, but it was a full point lower than the Fed funds rate a year ago, and now it's higher than the Fed funds rate too. Usually there's a bit of a spread. So we are really in interesting times, as they say, as interest rates go. And so to really impact interest rates, the government's going to have to show a little fiscal discipline. We're going to have to see some stable and consistent growth in the economy, and so that the markets will feel like they're not just continuing to give the federal government a credit card. Now, we're still the reserve currency of the world, and we're still the place where everybody flees to for safety when they get concerned about other markets. But that's what's really going to happen. We're at a 15-year low, or a 15-year shortage, rather, of housing, and so there's no lack of demand here, but housing needs to become affordable for more people for this to get balanced out. And where housing goes, so does the economy. So We'd love to hear your comments on that. Thanks for watching, guys.